My name is Marc Giannoni. I'm Assistant Vice President here at the Federal Reserve Bank of New York in the research group. The title of my presentation is Model for Forecasting and Policy Analysis. Monetary policy may seem very abstract to common individuals, but they affect their daily lives in very important fashions. So for instance, every day people make economic decisions that involve buying a car, not buying a car, buying a house, not buying a house, getting a mortgage, getting a fixed rate mortgage or not. And these decisions are crucially affected by the economic atmosphere, the economic situation, the likely evolution of key variables such as the interest rate, and these are variables that the Fed affects very importantly. There's a common misconception that people can look at the recent evolution of economic indicators and draw some inference from that. And for the macroeconomy, this is very complicated and often very misleading. So for instance, people go and look at interest rates and look at investment, and they realize that investment is not expanding very rapidly, despite the fact that interest rates are low. So they may conclude from that the Fed is not having much of an effect on the economy. The reason that the Fed brings the interest rates low to a low level is precisely in order to respond to economic conditions. And so by just merely looking at the correlation between interest rates and investment, you may conclude something, but in fact it is the Fed that is mitigating the effect of adverse shocks. The Fed as a whole is using a wide range of models in assessing the state of the economy and making projections for the future. So we are not wedded to any particular model, but a whole class of models that contain different information and that reveal different aspects about the state of the economy.